All right. Good morning, everybody. It's hump day. Got the oil report at 10:30. Got a little bit of risk off this morning. Europe's up 0.5%. Hong Kong right behind it. Not enough to really focus on those ADRs yet. We got a discrepancy with the dollar versus the 10-year. Something we're going to need to really keep an eye on today. The DXY, the dollar index, is headed to the upside. Not quite breaking out of yesterday's range yet, but it's working on it. More than halfway through the zone, it looks like. Could be getting close to the halfback. Yeah, no, we're past that. So we're through the halfback, but we've got the 10-year inside day breakout and expanding lower, but bonds didn't follow through. Just now getting up to yesterday's high. So no inside day breakout there yet. So there they are. They're trying to do it. Risk parity here. We have bonds going up and stocks are down. They're trying to turn around here just a little bit, but so far, no joy. This green line is a voodoo line. It's called Forest, I believe. You can see how we were fighting to get through it. And once we got through that resistance, we validated it as support. A little bit of a bear flag on the NASDAQ, which is turning into a bear flag failure. This expansion to the downside in the 10-year is worth keeping our eye on. This disparity between the 10-year and the dollar. Remember, a lot last year and even through, say, the first half of this year, the dollar and the 10-year were in sync. Both were moving up, both were moving down, and we would feel the effects of that in the S&P and the NASDAQ. And now we've got this. So approach with a little bit of caution, right? We're going to have to readjust how we gauge and measure the impact of these tools into the market structure that we generally deal with. We got more housing data this week, a little bit of consumer confidence today with home sales and some European central bank speakers as the morning goes on. We're going to get more data out of Japan tonight. And really, that's about it. It's a quiet week. We're looking to just clean out the rest of the year without really crashing and burning. I was reading on Spot Gamma dashboard. They have this founder's note, which is a really interesting read because this is written by someone who helped build the tools that Spot Gamma uses every day. There's some very smart individuals that are giving you, like a spoon-fed pieces of optionality and kind of explaining how this optionality may affect the broader markets. And the topic kind of wanders between the VIX and the various indexes out there, the Russell, the S&P. And what they were pointing out is that volatility is really low, but it's not going lower. The inverse relationship, the S&P goes up, the VIX goes down. Well, we've been grinding higher in the S&P this week, but the VIX set the low last week, and we haven't gone lower than that low, even though the S&P since last week has continued to go higher. So they're making an argument for topping out and just kind of grinding into the new year with a little bit of a dud, and they're sort of taking off the table the possibility of a blow off top, which is what a lot of us had been waiting on. That last hurrah into like 48, 48 and a half, 49, one of those big rallies to kind of top off the year with a bang. And we might not get that according to optionality. Eight 30, 10, and 10:30 today. It's our main time frames. Right now we're looking at the ES on a weekly. I still have that CVI indicator on the bottom down here. We are within the Bollinger Bands, but we're holding above that 10 really nice. And my approach on this is, as long as we're above the 10, we want to continue to focus on long opportunities. But we can't just use that as a blanket statement, right? Because we can be above that and falling down towards it. And then, of course, we'd have to really consider, do we still want to be long in the market? But as a simple tell, and there's a lot of those out there, this is just one of those simple tells. If we're above that blue line, the broader market should be approached from a long position, not a short position. We should seek out long opportunities in equities, indexes, various sectors that have a reason to be long. So sure, it pulled back some, kind of tagged that 20-week, but in the grand scheme of things, we are continuing to be bullish above that 10, and it's been a long time since we've seen this hold above the 10. We got a little bit of it back near the start of the bailout after the crypto collapse of that exchange, and everybody was getting nervous about the banks. Fed came in and played save a hoe. So that kind of brought us out of the March lows, and then we had the AI explosion that kind of took us into the high of the year earlier this year, back in August. So we started losing this before that AI push was even halfway done yet. We were losing it. It's not a perfect metric, right? This is not a trigger that tells you to get in or get out. But it didn't get through the 10 until after this pop, that last hurrah. There was a little bit more there, but really the drive was done at that point. So I kind of like it even at that perspective, that as long as we're above the 10, continue to try to look for long opportunities. And we can't sit around guessing well, it's weak, it's coming down a little bit, should we be out yet? It depends on the time frame of your trade. We did get through the distal line this week. We're back underneath it now, but we'll be setting up a new zone soon enough. We don't yet have a zone, enough candles yet to develop a zone. And this high was made so long ago that for the ES, we know that there's no unfinished business there, right? Those contracts have long expired. You can't have unfinished business if you're not holding a position from back then. But we can take that same concept and take it over to the QQQ or the SPY. Those positions would still be unfinished business, right? All right, so we're resting on that voodoo line. We're also resting on that daily pivot point. It's not an MDP now because we've hit it, but we did have one yesterday, and that matters for today. We're a lot closer to the lower ADR than we are to the upper ADR. To even get to the upper ADR, there's a voodoo line up there on the cog line, no less, 48.33, and then 48.36 to get to the ADR half. The vol trigger and the put wall are overlapping each other, 47.97, and both of them are above the previous week's high. Now, I know a lot of you aren't, that you don't speak optionality. So consider that put wall kind of an area where we would expect buying to happen. We don't necessarily want to call it support per se, but if a lot of buying comes in there, then I mean, it kind of turns into support, even though we wouldn't think of it as support. Support is a past tense word. Until we get down there and see that price was supported there, then that's just possible potential support. It's not support. And if price does bounce there and hold and move away from it, we can then say it was supported. Right now, it's just a possible buy zone. It's an area where we would expect increased buying activity, and that sort of activity would potentially hold us up. We're a long ways from zero gamma. Butterflies, iron condors, those strategies tend to work better when we're above zero gamma. And we expect low vol, right? Low day-to-day movement when we're this far away. Now, what they don't mention in that low volatility movement is that's if we continue going up. If we start to go down, those moves can happen with velocity, right? It's not a word I tend to use, but it fits. The volume is a little light today, but compared to what we've had, earlier this week, which was in the 60s, we're doing pretty good sitting in the 80s. Still a little light. Continue to stress about the volume, and this daily chart on the ES clearly represents that lack of participation, right? You can see the volume over the last 2 days compared to what we've had, say, from Thanksgiving to where we are now. It's a low volume environment. This isn't up for debate, right? We're not suggesting hypotheticals, not giving you my opinion. That clearly shows low volume. Got a classic B shape in this 10-day, 30-minute volume profile. The TPO has brought the point of control up to that zone that we had talked about. But since we continue to stay above that area with price, we continue to not add to that volume. And so we're not seeing the point of control come up. If we break that 47.60, we're very likely going to move through this zone really fast, just like we did the last time. You can see how shallow it is back here. So consider this a price shelf. If we break the shelf, fall off the shelf, then we're going to very likely move through there really quick. Now, I say very likely because there is the possibility that an inverse market will hit support or will hit resistance, and that resistance on that inverse market turns it around, makes it go the other way, which makes this go back up. You know, when we look back here and we ask, what did we hit? There's nothing here. There's no pivot point. It fell through the price shelf. Why didn't it just keep falling? Well, sometimes you won't find a pivot. You won't find what we hit. But if we consider an inverse market, say the Dixie, the VIX, the 10-year, any of those three could be the culprit. If one of those hit resistance and began to fall back, which would pop this back up, and that put us back up into the shelf. So if we break 47.60, it's possible that we fall through this zone really fast, but it's no guarantee, right? Because of that inverse relationship of something that could pop us back up again. Still no volume profile to carry forward. If we were going to carry it forward, it had already got taken out on that drop right there. A drop through the kill zone, no less, from 2 to 4. We didn't get reciprocation from that kill zone move, by the way. And we tend to more often than not. We're at the halfback for the RTH of yesterday's price action. If we take all of yesterday's price action, the halfback is 48.04. So if this 48.09 breaks, that's going to be where we seek out opportunity. Expect to see the same kind of behavior as we did on this halfback. A pause, a consolidation, a consideration on whether or not we're going to hold the line there and work our way back up, or if we're going to get a halfback break. And if we do get that halfback break, the target is the 25% mark. The goal would be getting down to the bottom here, but it's one level at a time, right? Get through the ADR half, get through the 25%, then get down to the low there. We would usually add things like RTH open, but really we're close enough to the open with that 25% mark that there's really no reason to mark them both. We could, of course, add Monday's high, but that lines up, you know, close to that ADR half anyways, and the roundy, no less. 48.11 is a cog line. Not really getting much help out of that. Or that. All right, we're close to 5% above the 10-week. We're there, right? We've been higher than this before, but this is about as far as you would want to take it. The idea that we pause here and let the 10 catch up to us a little bit makes perfect sense. It's rare to get beyond that 6% mark above the 10-week. So we're overbought. The thing is about overbought is it can stay that way for a long time. And one of the ways that it can resolve itself is just to quit going up, not to go down. All it's got to do is hold that level and digest. And at some point, a correction through time will get us through that, and we're no longer overbought. We're only 1.25 above the 10-day. We've certainly been higher than that. So in the shorter duration, we're good. We've got room to run, which kind of feeds into that narrative for a potential blow off top. We are maintaining inside the weekly expected move for the moment. We got there yesterday, spot on perfect yesterday, overshot it in the Globex last night, and now we've pulled it down. We've pulled in a little bit. But the edge of the weekly expected move for the moment is holding true. Remember, we're supposed to close inside this box 7 out of 10, statistically speaking. And since it's the S&P, 8 out of 10 weeks. So at Friday's close, we're supposed to be inside this range 80% of the time because it's the S&P. No, I didn't trade it. But you're right. That is one of the strategies. So one of my strategies, for people understand the question, one of my trade strategies is to go long off of the low if we get to the edge of the expected move low before Wednesday, or to go short off of the high if we get to the edge of the expected move upper edge before Wednesday. So yesterday, right, taking a put or putting on a call credit spread would have been part of the strategy. I didn't do it. I didn't put the trade on. I already have enough S&P trades on that I just didn't add another one. Bitcoin is up again this morning. Seen some crazy numbers being thrown around on Bitcoin, and there was a lot of news that had come out on different coins and different legislation around the world that very likely is going to affect coins. We are up a little bit, 1%. The idea, though, when I see Bitcoin up, is what's up with the proxies? You know, Coin, Mara, Riot, MSTR, Hut, Hive, the miners. So we're up a little bit, 1%. For Bitcoin, you know, that's not up very much at all. But I'd want to check those proxies to see how they're doing this morning, because they would certainly be a tradable opportunity for those of us who don't necessarily want to play in the Bitcoin space trading the coin themselves, but can still use it for, you know, tradable opportunity through the proxies. Uranium up a little bit, just more of a reflexive bounce than anything else. bonds at 0.5%. And that pretty much covers what's up. What's that? China ADRs down. The KWEP constituents also down. Nat gas. Well, we can't have nat gas in both directions. What do we have up here? Oh, uranium up, not nat gas. So emerging markets, semiconductors, the FANGs, China constituents all down this morning. Yeah, I'd say nat gas falling back out of bed. Big gap down in the KWEB constituents. BABA, Baidu, JD, PDD. We're going to expect weakness in all of those today. Although I got to say, PDD's been kind of doing its own thing anyways. It wouldn't surprise me if it's trying to buck against this. Yeah, I mean, it's trying. It's certainly holding up better than I'm betting a lot of its peers that did. Yeah, they're all hit. Some cloud computing, so we'd expect things like Google to be down this morning. And that is not. So what's up with cloud here? You know, cloud is an illiquid ETF. It's one that you have to be careful with because it'll be in the pre-market. There won't be any flow, and it'll still be showing what happened last night. So then you're thinking, oh wow, look, it's down, and in reality, it's not. So it's one of those that you want to check. It went into the close high yesterday, so there could be a little print hiding down in here. So there it is. Cloud computing this morning just gave a print way down here. But whatever sent us down there, it wasn't Google. Amazon's got cloud services, Microsoft. There's so many cloud services out there. We'd have to dig through it to find out which one. The thing is, it is an ETF, which means you can open it up and see the biggest holdings in there and kind of sort through and find whatever caused that big drop. Now Google's starting to catch up a little bit. History in the making. That's a dark pool print. All right, getting a little whiplash on semiconductors as well through SMH. And pot stocks are up this morning. They're not up significantly, but they are up. A lot of their run this year was due to potential legislation changes, and that sort of just dried up, and down we went again. So if it is up this morning, we're not talking about a change in structure, just a potential possible day trade. Got a continuation on CGen. This started yesterday. You can see this 1-day bull flag. The longer this flag goes on, the more likely it is that we're going to dump back down. That's one side of the argument. IFBD is another one that's trying to gap up this morning. Starting to get some volume coming in on the tape. Pull. Just day trades, right? Nothing on these for swing trades. LGVN. Or ACON. Yeah, it's not looking really hot out there, even for penny stocks. All right, this split between what's going on with the dollar and the 10-year, I think that'd be where I put most of my focus. Also, I say this from time to time, and it holds true. If you're losing more often than you're winning, do the easy stuff, not the hard stuff. I know it sounds really simplistic, but on a day like this, it really sticks too. Focus on answering some very key, simple questions. Are we within our own Globex range? Yes, no. Are we within yesterday's RTH range? Again, yes or no. And then are we inside of yesterday's range itself? Because trading will be easier if we leave the range that we're in, right? You can see last night, while probably most of us were sleeping, when we were in the range, it wasn't that great. But when we left the range, we started to actually get some opportunity there. Then we stayed in the range. We were just chopping about. We're still inside this bigger range from yesterday, the RTH. And as long as we're inside of yesterday's range, that is going to be, as much as we can get. Very likely choppy, quick reversals, no dominant theme. Who's in control here? The buyers or the sellers? And when it's not easily identified, well, then that's the rub, right? When every single trader is buying, it's really easy to join. When everybody is selling, it's really easy to join, right? Doing the easy stuff. So I get it. Nobody wants to sit around waiting for those kind of days. Just, try to put it into context. We don't have a dominant theme this morning. We don't have a narrative to carry us. We have no reason for the markets to continue to leg up and go higher. We don't necessarily have any really negative news to send us lower. There's no, you know, really heavy economic schedule to put us in pause mode while we wait for some, save a whole market gesture. Ooh, got nothing. And the markets are going to start looking for an excuse, right? Like, give me a reason. So that's what we want to start watching for. Serious flows to begin picking up and driving this market. Watch the clock, guys. Be careful. Be safe. I'll see you all tomorrow.